No one ever said investing was easy, and these days it's made even more difficult with the amount of news and noise and outside influences that easily make their way into our daily lives before we're able to make a decision. In today's video, let's look at how this pain could form for the everyday investor and how we can best avoid this. We've got the stock markets to get through and some major market sentiment updates. If you haven't already, smash up the like button, subscribe to the channel. We are here as your home of macro cycle analysis across the stock markets, commodities, real estate, and crypto. How do we do it? I'll leave that up to you as you watch and tune in to the daily videos here on the channel. And also, top of the video description, our free crypto and economic reports emailed directly to you once every 2 weeks. Jump on that list down there, and we have far more information coming up for you guys right there. So the first thing I want to look at are the indices before we get to some of the macro market sentiments flipping. But of course, there can be a lot of pain coming up this year for investors. And I don't mean pain to the downside of people buying at the tops and watching the market tumble against them. There can be some serious pain for investors that miss out on this run. And I want to show you that in detail in terms of actual raw data, not my opinion, just the data from the charts looking back at 90 years of history. So we'll get to that, but just first up, we want to have a look at, is this bear market over? No doubts I'll make a video on this in the future talking about the bear market being over, but technically we just want to see what this means, what investors have all agreed on. Essentially, the bear market is over when prices rise at least 20% from the bear market low. So we know that bear markets begin once the prices drop 20% from the highs. So they say the same thing in reverse from the lows. And if we take a look at the low point here in October to the top that we've seen in January so far, we're at 20.1. So essentially you can say that the bear market is over, technically speaking here. Of course, this isn't the greatest metric to say that a bear market is over. I wouldn't just rely solely on this metric, as we know from history that it doesn't always work out in that way. However, when it has worked out, it's typically been a pretty good time in the market to be buying. Even if the market does fall after the 20% rise from the low, in the past, it has been shown to be closer to the bottom. So this is the point here that I want to mention. Looking at, this is the GFC dump on the S&P, the low from November into the peak of January. So kind of a similar timing to what we're currently seeing, ran up 26.2%. Now, of course, the market tumbles into March, which is another reason why we're looking at our cycles, looking at March having a low come into the market. Doesn't necessarily mean it's going to be a lower low than October, but I think we'll probably see some sort of significant low coming up in Q1. Something that I've said many, many times on the channel, going all the way back to late 2022. Let's wait and see. Essentially, that did rise up 26%. The market then crashed again to that March low, and the fall was 29%. So still quite significant for investors' portfolios. But like you can see, it was coming towards the end of the entire move. And if you'd bought in this zone back in 2008 and 2009, you would be extremely happy with yourself saying that you caught the bottom. And by all means, you can definitely say that you caught the bottom. That is the bottom of the market. And like we know from history, there's a GFC low. This market has just gone absolutely ballistic from that low. We can go to the Dow Jones from where we currently are. So essentially, we've looked at 20% up from the low is technically calling for the bear market to be over. However, like we've just seen, sometimes in the past, that isn't necessarily true. So we've got more data to get through, but let's look at this for now. So from the low to the current top, it's over 20%. We're at 21% for the Dow Jones. For the NASDAQ, from the current lows of October to the current highs in January, we're at 23%. And if we take a look at other indices around the world, we're starting with Australia, the bottom to the top, we are now at 18 or a little higher percent there, getting extremely close to the all-time high. So this leads me on to the next point as well. If we tend to wait for more and more confirmation, we obviously lose out on some of these gains from the bottom. Sure, I hear some people saying, why don't you just dollar cost average in? That's another strategy if you choose to use that, but timing is a really important step here for many of these markets, and that's what we focus on with our macro cycles. So looking at the Aussie market, it is less than 1% from its all-time high price. Looking at the UK market, it did on Friday hit a new all-time high price. Is it out of a bear market? It's hit a new all-time high price. I don't know any market that is still called a bear market when it hits a new all-time high price. Big thing here we have to separate is what's going on in the economy and what investors are doing with their money to make more money. In terms of the economy, I agree with everyone out there. I think food's too high. I think rents are too high. I think property prices are too high. I think energy's too high. I think everything is extremely inflated in prices. But I can't trade those markets. And in terms of being able to actually trade the markets and make money from it, I need to go with what is happening on these bars and candles in the charts, not what is happening at the grocery store in terms of prices of eggs. So in this case, the UK market, the FTSE 100, hit a new all-time high price by 1 point, sure, but it did hit a new all-time high price. The Indian market has been hitting all-time high prices since November and also in December of 2022. Why do I bring these up? Well, these are emerging markets, and these are the typical markets that tend to go first when the markets begin to move, and the US will begin to catch up with these. And so there is a lot of data in terms of these markets saying that they are out of bear markets. I mean, they're hitting new all-time high prices, and also some of these being up 20%. So like I said, we're going to get to that other reason why it's possible that we're going to see big pain for investors who are waiting this year, and also higher prices as well. So far, I've just given you all of the objective data from the charts, just looking specifically at low prices and high prices and the timing of when these particular prices are coming into the market. We've done nothing subjective so far. Sure, I've given you my opinion about what I believe is going on with the prices of food and utilities and rent and sale prices. You know, that's just what is happening at the moment and my thoughts on it, but that doesn't change the market. I can't change the market in terms of that. If you are finding value from this and you want to share it with someone, by all means, go down below, hit that share, give it to a friend who believes the markets are about to capitulate and fall into these new crash lows. Let them see some of the other data that is coming out there, just like this particular one here. Investors' debt level has been falling. So we often see this at the low. So we're looking at the S&P 500 and number of months in past 18 months with a decline in margin debt. So investors are deleveraging at a rapid pace, so getting rid of that bad debt in order to start to position themselves for this next particular move. And we've seen this quite often going all the way back to the 1930s. So call it around 90 years of history. I do have some more 90-year history coming up as well. But in this case, you can see a lot of these major bottoms align with number of months in the past 18 months with a decline in margin debt. So that's 14 here. Now I want to take a specific look at this one here because this was right in the middle of the decline. Now this is the area in question where the margin debt levels were rising. So the investors are deleveraging, getting rid of the bad debt, and that was happening in the middle of this particular drop. This is the dot-com wreck from basically late 2000 to late 2002, call it early 2003 if you're looking at that higher bottom. But essentially, there was just that one period in the middle at the first bottom, and then the final bottom was registering at around this period here, so the number 12, so the 12 months within that 18. So although it didn't hit it on the head, it was very, very close to that next stage of the bottom. And we can go all the way forward to the 2009 low, 2008, 2009 low. Again, that was up here at around 11 on the reading. And each of these next major lows all coincided with significant lows in the S&P. And this is the pandemic low. We can take it back to some of the lows in the 50s and in the 60s, again in the 60s, in the we start to get into the 70s here as well. So it's not a 100% accurate indicator, but nothing is. But in this case, there is a high probability that we are passing through a low or just have turned from the low. Like we discussed in the intro of the video, looking at lows and highs of the market can be quite difficult to identify. And it often brings up a lot of conflict with other viewers out there or people who are also in the market because everyone is trying to be right. I mean, I'm trying to be right because I'm putting my money into the market, which I assume you are as well if you're watching this content. So I do want to give you some of the opposite side to the equation. Maybe there is still a case for a bear, but we need to understand the timing of that particular information. Is it a short-term top in the midst of a long-term bottom? I'll get to that in just a moment. But we have more data here about unemployment, because this is a big one that has been coming up a lot lately as well. So a good one here from Seth. If you haven't followed him on Twitter, go and check out his account. A lot of this sort of great data is from there. Historically, whenever unemployment rate has crossed above 12-month moving average, a recession has almost always followed shortly thereafter, by average of 3.5 months. So the red dot is where we are getting the crossover, and then the gray in the background is the recession. So red circle, you can see the cross here, gray in the background. Recession, 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 and recession, recession, recession. You can go all the way back here. So the next part of this tweet is further from 12-month moving average unemployment rate today than back in October 2022. So the unemployment rate today is further away from this moving average than it was back at the lows, which is essentially signaling that we are not due for a recession yet. Now, even if there is a recession, the market is still on the way up. So it depends on what you are trying to trade here. Are you trying to trade the call of a recession, which may in fact not give you any downside in the market? Or do you want to be trading the lows to the highs and taking a chunk of profits out of the middle of the market? Big thing to distinguish here, because there is a lot of talk about a recession from the news and the media outlets. And essentially, you can't necessarily trade the term recession. If the Fed calls that there is a recession, maybe the markets get shocked for a brief period or a longer period. At the end of the day, our jobs are to make a chunk of profits out of the middle of the market. And unfortunately, I can't trade the word recession. If you can, and you've made a market for it, let us know in the comments section down below. Now, here is the flip side to the bullish case, and this is looking at medium-term risk levels. So this doesn't mean that we'll go to new lows and break the October low that was set in October of 2022, but it could mean that we are looking like a bit of a intermediate top is forming at the moment. So medium-term risk levels for the S&P 500. So this is the highest level since early 2021. So this is the dates down here, January 2021. You can see that this is 2021, and this was the top of the medium-term risk level. We are now above the high risk. So that's the reading here through that horizontal, and this is the highest level that we've been. So the medium-term risk is that we are currently seeing at least an intermediate top on the S&P, which coincides with the data we looked at in yesterday's video, where we could expect to see some of the smart money selling out, waiting for the next low to come into the market. And that brings up the next point here. What looks like opportunity to you? Is opportunity buying Bitcoin above 21,000? If we get a breakdown from the current levels of 22K, is that opportunity? Or are you looking at opportunity below 18,000? Are you waiting for this market to dump back to 18? Or do we zoom out even further and you're expecting the market to go below 15,000? What does that opportunity to you look like? Are you expecting bigger dumps on the market? So this is all going to be relative to your time frame and at what position you believe the market is in. Obviously, if you've been following the channel, I think there's opportunity somewhere between 18K and about 21K for this particular drop, just like we looked at in yesterday's video, where we could expect this to be either a pause, so somewhere where the market just churns around between that 21 and 24, or maybe we get that bit of a dip slightly lower to 18. And if that doesn't ring opportunity to you between $18 and say $22,000, and you're expecting much lower prices, just have a plan for in case the market doesn't get to that point. Because next thing we know, maybe we only get that short dip and then the market starts to move away over the course of 2023, leaving all of those extreme bears behind. So it's just a matter of weighing up the probabilities. What does opportunity mean to you? Should you be buying at these levels, buying a little more at 18, and then sell on the house if it goes under 15? And if it never makes it to that point, what do you do after that point? Now for the extreme pain over the last 90 years. S&P 500 annualized real total returns, 1932 to 2022. When I saw this, this was absolutely incredible. We all know the old saying, time in the market beats timing the market. Well, in this case, it's both. If you're not in the market and you're still waiting to get into the market, this could absolutely destroy your portfolio. From October 1st of the year 2, so we're looking at the presidential cycle here. Right now we're in 2023. This is the third year. Last year was the second year of the presidential cycle. And in 2024 is the fourth year. So that's basically where the elections occur. We're in the third year. So from October 1st of year 2 to April 30th of year 3, a 6-month window, the majority of the gains happen. This is timing, not time in. So timing the market, the majority of those gains are made looking back over 90 years of presidential cycles, which are essentially 4 years. We're currently in year 3. We have February, March, and April to go. So we have 3 months to go. And my mistake earlier, we actually have 7 months, not 6 months between these periods here. Nonetheless, if you miss out on these moves, waiting for that collapse or waiting for the market to give you another signal, all other times in the market have resulted in less than 5% return. So this could be extreme pain for portfolios. I definitely don't want to be in the markets risking my savings, risking my investment money for a measly sub 5% return. It's just not worth it. So missing that 7-month period of the presidential cycle could lead to some extreme pain. If you need to share this with someone, do so. Hit that share button down below. While you're there, like, subscribe to the channel, and subscribe to our free crypto and economic report emailed to you once every 2 weeks. Don't go anywhere. We are back here again tomorrow looking at some of the more macro cycles on Bitcoin and the stock market. I hope you enjoyed that. Let me know in the comments down below, and I'll see you guys at the next video. Until then, peace out.